Hi friends, welcome to part B, practical questions on partnership accounts. So in class 11, you have learned about journals, ledgers, trial balance, profit and loss account, and balance sheet. So when you were learning about all these things, you only had one capital account because there was only single owner for this firm. This kind of a firm we call it sole proprietorship. Now in class 12 you will be learning about partnership firm. So along with in a partnership firm there will be two or more owners. Since there are two or more owners, our work doesn't stop at profit and loss account. We will have to take this profit that we arrive from profit and loss account and prepare something called profit and loss appropriation account. Now, why are we preparing a profit and loss appropriation account? We wanted to account for things that we are paying or receiving from the partners of this firm. So earlier you only had one stakeholder, one owner and a single capital account. Whatever is happening in this business belongs to him. Profit or loss, salary, etc., belongs to that single owner. Now you have two stakeholders. One partner will be looking into accounts so that he can make sure that the other partner is also getting the right amount of profit, other benefits of the firm. Now, profit and loss appropriation account is made to apportion the profit that is obtained from the P&L account. So obviously, if there is a profit, it will come on the credit side of profit and loss appropriation account. Now, on the debit side of profit and loss appropriation account, you will have many things like interest on capital, salary, commissions, etc. paid to the partners. Salary paid to an employee will not come in profit and loss appropriation account. It will go in P&L account. If something is paid to the partner, like a salary, commission, etc., then this is going to appear in P&L appropriation account. And on the credit side, if partner is paying interest on drawings to the firm, then that will come on the credit side. Okay. Now there is specific calculation involved for all of these items. A salary might have some kind of adjustment in the question. So let's take for example interest on capital. So on interest on capital, if the capital of the firm put in by one of the partners is if it is 1 lakh and the interest on capital is 10% mentioned in the partnership deed. So you have to remember that it has to be mentioned in partnership deed. Now, if it is not mentioned in partnership deed, not mentioned means no interest. Okay, so if it is mentioned in the partnership deed that 10% interest can be provided on partner's capital, then you can give interest on capital. So if 1 lakh is a capital and 10% is the interest rate, interest on capital will be 10,000, 1 lakh into 10%. Now, interest on drawings. Now, in case interest on drawings, percentage, etc. is mentioned in partnership deed, then we provide interest on drawings. Again, it has to be mentioned in partnership deed. If it is not mentioned in partnership deed, it means that we cannot pay interest on drawings. The partner will not pay. We cannot demand it. Okay. Now, if it is mentioned in partnership deed that interest on drawings is 10%, then how will you calculate interest on drawings? First scenario, if the partner is withdrawing every month 10k each, so every month from April, May, June, July, he is withdrawing 10k each, 10k, etc., and until March he has withdrawn 10k. So 12 months 10k, if he is withdrawing, the total will be 1,20,000. 10,000 into 12 months. Now, if he is withdrawing this amount at the beginning of every month, then how will we calculate interest on drawings? The total drawings is 1,20,000. Interest percentage is 10%. Now, can we assume that we can take interest for the entire year? No, because if he has withdrawn 1,20,000 in the month of April, then we can straightly calculate 10% interest on drawings. So in this case, he has withdrawn every month, beginning of the month 10k. So in this case, interest on drawings will be calculated for 6.5 months. Okay, it will be calculated for 6.5 months. Now, if it is withdrawn at the end of every month, if it is withdrawn at the end of every month, it will be 1,20,000 again into 10% into end of the month, it will be 5.5 months. Interest will be calculated for 5.5 months. Okay, and if it is on mid of every month, this 1,20,000 into 10% interest, it will be calculated for 6 months if it is at the mid of every month. Okay, now you have to remember this. Now in the question, if it says that the partner has withdrawn capital at the beginning of every month, interest will be calculated for 6.5 months. If it is at end of the month, interest will be calculated for 5.5 months. If it is at mid of the month, interest will be calculated for 6 months. Now, what if it is at the beginning of every quarter, which means that he has made so here there are 4 quarters. In April he has made a withdrawal of 30k, and then after 3 months in July he made a withdrawal of 30k. Then after 3 months in October he made a withdrawal of 30k. Then after 3 months in January he made a withdrawal of 30k, beginning of every quarter. So in this case also we will calculate interest over 1,20,000 multiplied by 10%, and how many months we will calculate? It will be 7.5 months. Interest will be calculated for 7.5 months. Okay. Now, if it is at end of every quarter, so in this case, what's going to happen? Okay, I will mark it in red. So end of quarter means first quarter, it will be a withdrawal of 30k here in June. Then the next withdrawal will be on September. The next withdrawal will be on December and March. Again 30k, 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 30k. It will be 1,20,000 total. Then here also we are going to calculate interest at 10% for 4.5 months, because it is withdrawal at the end of the month. So less number of months to be calculated. So if it is beginning of month, it is 6.5 months. If it is end of every month, 5.5 months. If it is end of mid of every month, then it is 6 months. Beginning of every quarter, 7.5 months. End of every quarter, it will be 4.5 months. Now, if the question is silent, question just says that okay, the partner made a total withdrawal of 1,20,000 during the year. So, if it is mentioned during the year, we will assume that the withdrawals happened during mid-month, and then we will calculate it also for 6 months. So for during the, if the question is just mentioning that the partner withdraw a total of 1,20,000 during the year, we will again calculate it for 6 months. Hope you got this. Now all these kinds of calculations we are doing to come up with a figure here in P&L appropriation account. So interest on capital will put, salary will put, commission will put, interest on drawings, etc. will put. All these things we are keeping in P&L appropriation account to find out what is the divisible profit. Divisible profit means after appropriation of the necessary items pertaining to partnership date, we are finding the profit that can be divided among partners. So this can be divided among, if there are two partners A and B, this profit can be divided among partners. And how will you divide it? In profit sharing ratio. In profit sharing ratio. So if profit sharing ratio is 1:1, we will divide it equally. If it is 2:1, 2/3 of that profit will go to partner A and 1/3 of the profit will go to partner B. See, so we will be dividing this in this divisible profit in profit sharing ratio. Then we are going to prepare, the next thing that we are going to prepare is partners capital account. Partners capital account. So what is the speciality of partners capital account compared to the previous capital account we were preparing during sole proprietorship, or in class 11 we were preparing capital account? The only difference here is you will have a same ledger, but since there are more number of partners here, you will have an additional column for mentioning the partners separately. So if there are two partners A and B, then you will have two columns on the debit side and you will have two columns on the credit side, A for A and B. Now partners capital account can be prepared in two ways. Okay, one, we could follow a fixed capital method. There is a fixed capital method. Okay, we have two methods. One is fixed capital method and then the other one is fluctuating capital method. So in fixed capital method, the capital balances, the initial contribution of the partners, etc. will remain the same, and other adjustments including interest on capital, interest on drawings, etc. will be on current account. On a fluctuating capital account, it's similar to how we were preparing capital account in class 11. The capital contributions plus any other adjustments will be put in the same account. Okay, we will discuss more on this with an illustration soon. So let's understand capital account of a partnership through this illustration. Samir and Yasim are partners with capitals of 15 lakhs and 10 lakhs respectively. They agree to share profit in the ratio of 3:2. Show how the following transactions will be recorded in the capital account of partners in case 1. The capitals are fixed and 2. The capitals are fluctuating. The books are closed on March 31st every year. And there is a set of transactions that is given for this partnership firm, which is additional capital contributed, then interest on capital, drawings, interest on drawings, salary, commission, share and loss for the year 2005. So again, we need to note a few things. One is that we have an opening capital which is 15,000 and 10,000. And again, the profit and sharing ratio is 3:2 here. Now, on the additional capital contributed, we have 3 lakhs and 2 lakhs respectively. Now, when we are following fixed capital account, we need to record only the capital incoming and outgoing in partner's capital account. Rest of the transactions like interest on capital, drawings, interest on drawings, salary, commission, etc. will form part of partner's current account. Now let's start doing this problem where we have the balancing figure, the opening balance, okay, of 15 lakhs and 10 lakhs. Okay. Then we have an additional capital which is of 3 lakhs and 2 lakhs, which brings the total of this partner's capital account to 18 lakhs. And here it is 12 lakhs, 10 plus 2. Now there is no entry in the debit side because there was no, capital was not withdrawn. It's only additional capital. So we will bring the balance here itself, the debit side. So closing balance or balance carried down for this fiscal year will be 18 lakhs and 12 lakhs. Now, the rest of the things will go in partner's current account. First thing is interest on capital. Interest on capital will increase the partner's capital account. So it has to go on the credit side. Interest on capital. So it has to be calculated on 5%. So let's do a working note here. Working note. Interest on capital. First, it is for Samir. So he has 15 lakhs capital at 5% for the entire year. So it will be 75,000. Again, there was an additional capital that he bought in on 1st July. So here it says on 1st July they have bought additional capital which is 3 lakhs. And that also has 5% interest on capital. But this is not for the complete year, but it is for a period of only 9 months from July 1 till March 31st, end of the year. So 9 by 12. Which is 11,250. Now if we add 75,000 plus 11,250, total interest for Samir is 86,250. Now let's do it for Yasmin. For Yasmin, we have again 10 lakh rupees of capital from the beginning of the year until end of the year. So that will come to 50,000. Then he bought in 2 lakh rupees of capital on 1st July 2005. So that will carry 5% interest, but only for a period of 9 months from 1st July till 31st March. So 9 by 12. So it will be 7,500. Total of this 50,000 plus 7,500 will be 57,500. Now interest on capital, we are going to keep this here. For Samir it is 86,250 and for Yasmin it is 57,500. Now the next thing is drawings during 2005, the complete drawings. So we have to mention drawings, it is 30,000 and 20,000. Interest on drawings, this will also decrease the capital. So interest on drawings is 1,800 and 1,200. Now we have salary. Salary to a partner will increase his current account. So we will mention salary on the credit side. Salary, which is 20,000 only for one partner. Now we have commission, which is 10,000 and 7,000. Then again, share in loss for the year 2005. Now if there is a loss, partner's current account has to be decreased. So it will be on the debit side. So P&L appropriation account, which will be 60,000 and 40,000. Now if I take the total, it is 86,250 plus 20,000 plus 10,000, it will be 1,16,250. And then for Yasmin, it is 57,500 plus 7,000, it is 64,500. I'll put the totals here also. 1,16,250, 64,500. Now the closing balance will be 1,16,250 minus 30,000 minus 1,800 minus 60,000. It will be 24,450. And for Yasim, it is 64,500 minus 20,000 minus 1,200 minus 40,000. It will be 3,300. Now we got partner's capital account and partner's current account balances when we do capital account on a fixed capital method. Now let's see if we are doing it on a fluctuating capital method, how it will be. Okay, so it's easy, since we have already done the fluctuating capital method. We can take all the credit items together in partner's capital account. It was a regular partner's capital account that you have done when in your class 11 also, when you are doing sole proprietorship. First is balance. Balance, we have 15 lakhs and 10 lakhs. Then we have additional capital, which will be 3 lakhs and 2 lakhs. Then we have interest on capital, which is 86,250 and 57,500. Then we have salary of 20,000. Then we have commission of 10,000 and 7,000. Okay, now let's see who can do the math pretty fast. Okay, we have 15 lakhs plus 3 lakhs plus 86,250 plus 20,000 plus 10,000, which is 19 lakhs 16,250. And for Yasim it is 10 lakhs plus 2 lakhs plus 57,500 plus 7,000. It will be 12,64,500. Now on the debit side, we know what are the balances that is coming on the debit side. So we will have a drawings which is 30,000 and 20,000. We will have interest on drawings, which is 1,800 and 1,200. Then we have a P&L appropriation account, profit loss distributed 60,000 and 40,000. Then we will have our balancing figure 19, 16, 250 and 12, 64, 500. So let's calculate 19 lakh 16,250 minus 30,000 minus 1,800 minus 60,000, which will be 18 lakhs 24,450. And then we have 12 lakh 64,500 minus 20,000 minus 1,200 minus 40,000, which will be 12 lakh 3,300. So this will be the final answer, because both current account items and partners capital item will be combined when we are following fluctuating capital method. So on fixed capital method, we will have capital account and current account separate, but on fluctuating capital method, we will do it on a single partner's capital account. Don't miss out part C of this chapter, wherein we will be discussing on profit and loss appropriation account. Please subscribe to our channel. Thank you.